Hi, welcome to the Market Alert for Friday, the 17th of April 2020. So, stock surge on soaring unemployment, fourth week in a row. As I've said before, no surprises there really. I said this yesterday before they released the figures, that this is what we could expect. Bad news is good news as far as the stock market is concerned. This is the way they're going to play this for as long as they can to keep moving the stock market to the highs, because that's what's important to the 1% elite. And also for perception that everything is fine and this is nothing, as it says here, nothing to see, move along. So let's have a look at yesterday's jobless claims. And we'll start off by looking at this actually. This is from the FT, and you can see in the last 4 weeks the job losses in the US now stand at 22 million, a massive number, unprecedented, never seen before. So let's have a look at the detail. This is when the figures were released. You can see the market moving up 200 points. Each red line represents 100 points. So there you can see 100 points. The market making back all that it had lost earlier on in the session. Prices had moved higher in the first part in the futures market and had started to move back. You can see giving back 50%, coming down to the 200 MA. The news comes out, the market moves back to the upside. Prices sell off initially. I'll just move that over a bit. Prices sell off as the cash market opens, closing below the DP level, which becomes bearish, and also the 200 MA, with prices trading down to the previous day's low. And then prices manage to rally back up to the 200 MA and the DP, but then fail again, create a double bottom down at the previous day's low, before prices then start to move to the upside and eventually break through the 200 MA and the DP level before the afternoon close in New York. And prices have gapped higher. If you're wondering why, well, there's a couple of reasons. The first is this, that Trump to hold major news conference at 6 p.m. This was 6 p.m. Eastern Standard Time yesterday. Will announce reopening guidelines, and here we go again, $2 trillion infrastructure package. Nothing was really mentioned about this. It was more about how they were going to open up the economy again following the last 3-week close down and lockdown. But again, no surprise here. They're going to keep printing and printing and printing until eventually we end up with hyperinflation. But before that, we have to go through a major depression and recession that you've never seen before. We've not witnessed. Certainly, many did in the 1929 era in the US with the Depression, but this is, or the Great Depression, this is already been titled the Greatest Depression. And the other thing that set the market to the upside as well, if I can find it, it seems to have disappeared off here. Let me just see if I can get this for you. It's here. US futures saw on report of positive drug for the coronavirus. So the combination of the two has seen the market gap higher, and that's where this gap comes from here. So the futures market currently moving to the upside above the DP and the 200 MA, and moving strongly to the upside there at the moment. Generally, you tend to see a gap is filled in charting terms. They tend to see prices come back down, fill the gap, and then move higher. So there's a possibility of this happening too. Meanwhile, in the daily chart, as I said, I think it was in Tuesday's market alert about could the stock market go back to the all-time highs. Well, we're starting to see this. Any sort of positive news from the withdrawal of a lockdown, drugs, vaccines, etc., will see the market move higher. However, this 200 MA is going to be a major obstacle. It's certainly going to have a good attempt at moving higher as the market also heads towards the 76% retracement from the high to the low over the last 6 weeks. Also is going to be an issue for the market, as is the 50-bar moving average. So these areas here are going to be critical before we have any attempt of getting back to the all-time highs. But given the lunacy and certainly the recklessness of the money printing at the moment. This is where it finds its home. They're certainly not going to go to the consumer. It's certainly not going to go out of the banks either. They're going to hang on to it because the only place where they can get a return at the moment is back in the stock market. Meanwhile, the implied volatility is starting to trade sideways. So really not a lot to report here. I don't think we're going to come back down to these sort of levels for a very long time. This could be forming a bit of a base here as well for the implied. Also, other news, just to show you how bad things are going to be. China has reported a minus 5% on the year-on-year GDP figures. This is just the start of it. And if China have got a -5, then expect -30 and the likes in the UK and in the US as well as we go forward. I don't think people have really grasped the concept of what the first 3 weeks of a lockdown has done to the economy, let alone another 3 weeks here in the UK. I'm not saying the lockdown is a bad thing. I'm not talking about the impact of the economy. Most people's focus tends to be on the here and now without looking forward, whereas for me, I've always looked forward for trends and also how to exploit those. And I can tell you this now, this is going to be really, really bad. I don't want to be the prophet of doom or the bearer of bad news, but hey, I'm used to it. And generally proven right as well, which is, I don't say that out of ego, but purely hard work, research and looking into these things. And it is going to be bad. There's, you only need half a brain cell to see this. The trouble is we've had 40 or 50 years of printing money, bust and boom. And that's been the pattern. The housing market's always moved higher. But again, that's not going to happen. It's not going to happen. All of the estate agents are closed down in the UK. And already forecasts of -20%. And I think that's conservative, personally, of what we're likely to see as far as the housing market is concerned, let alone the buy-to-let market, people that have got mortgages on those, and then, of course, the debt holidays on mortgages, and also no doubt something coming for those that are tenants in these rental properties as well. So massive destruction coming in the housing market as well. It's usually stock market first, followed by housing market collapse as well, which we've not seen for a long time, since the early 1990s. So yeah, we live in interesting times is all I can say. And the markets, for me, a very interesting pattern here. Like I say, for me, let's try and get the market up as high as we can. This for me wasn't the crash. This isn't the crash. This is a correction, major correction. Bring the market back. When it fails, then all of the bad economic news items start to come home, and the reality of how bad it is. And then, after printing trillions and trillions and trillions, which hasn't worked to revive the economy, and it will not work either, because the banks aren't going to lend to a company that they deem to be potentially insolvent. That adds to the job losses, that adds to the problems, and consumers don't spend, and the major corporations don't see any profits, and the whole thing becomes bad news going forward. It's as simple as that. Okay, that will do it for this one. There are no economic news items today, as shown here, so the market's going to have to make its own direction, and I wonder which direction that will be in. So we'll soon see. But that's it for this one. Also for this week, I will see you in Monday's edition of the Market Alert. As ever, thanks for watching. See you in the next one.